Breaking ETF news. Betashares issues a supplementary product disclosure statement for its Australian Hybrids Active ETF, or HBRD, to its friends, and announced major changes to the fund, its investment universe, and the fees charged. All of these matter to investors in HBRD, so if you or your parents are invested, listen up. Meanwhile, Vanguard launches an S&P 500 ETF and takes the challenge up to BlackRock's IVV and State Street's SPY. Is it time to ditch IVV? Today, we're looking at these two stories in detail so you can decide what to do and when to do it. But that's after this. Hi, I'm Vince Scully, Portfolio Manager at LifeSherpa Invest, and this is Investing. Today, we're talking about the Betashares Australian Hybrid Active ETF, HBRD, and the changes announced that will take effect from March 31st, so just a couple of weeks from when I'm recording this. HBRD is an actively managed fixed interest ETF that invests its $2.6 billion in assets across a range of hybrid securities, corporate bonds and cash. Most of that exposure is to banks both in Australia and overseas. It's designed to deliver a higher yield and return than traditional fixed interest by accepting a bit more risk and investing in lower ranked investments. And it's more or less delivered on this objective, delivering 4.39% annualised return over the 5 years to December 31, 2025. A good comparison is the Betashares Australian High Interest Cash ETF, or AAA, which invests in short-dated bank bills and term deposits, so much better credit quality, and returned 2.88% over the same period. HBRD also delivered a little bit of franking, about 5%, so that boosts your return a little bit, especially if you're a retiree on a low tax rate. The spread or increased return has narrowed, though, in recent years, with the one-year return for HBRD being 4.79%, and you got 4.08% in AAA. So that's a 0.71% premium. So you've got to think about whether that's an appropriate return for the risk or not. The fund is managed by Coolabah Capital, which is run by Christopher Joy. And for my money, if I were to invest in hybrids, I would only do so with Chris's management. But I'm getting ahead of myself a bit here. To understand what's going on, we need a little bit of history. And what else would you expect on this podcast? The hybrid in the fund's name refers to securities that have characteristics of both debt and equity. And this matters to the user or investor because debt is generally, the issuer, because the debt's generally tax deductible, whereas equity dilutes other shareholders' returns and is generally more expensive. Some investors value a lower risk, more income-focused investment provided by debt and can benefit from franking credits available on equity distributions. Banks and insurance companies are required to maintain a high level of capital or equity. In Australia, these rules are set by APRA, the Australian prudential regulator, which are broadly in line with the global rules under the so-called Basel Agreement. And we're now up to version 3 of those rules, or Basel III. And so if you can build a security that meets all 3 of these requirements, everyone wins, and especially the investment banks paid to structure and market these instruments. But this is tougher than it seems. And so we've got to understand a little bit about how bank capital is created. And so bank capital, that is the backing for banks to be able to make loans, is divided into tiers. So tier 1 is the core of this, and that's equity, so the shares that the bank issues, the retained earnings, the profits they've made but haven't paid out as dividends, and usually intangible assets like brand names and IP are deducted from that. And they get They qualify as Tier 1 because they don't require the bank to make mandatory repayments of principal, interest or dividends. And usually this is referred to as CET1 or Common Equity Tier 1. Tier 1 is a bank's supplementary capital and it's designed to absorb losses before creditors or depositors. And this includes things like subordinated term debt with an original maturity of 5 years or more, hybrid instruments, which is what we're talking about today, such as certain types of preferred stock or convertible bonds. And it also includes a whole bunch of accounting provisions like revaluation reserves and general provisions for loan losses. These are less secure for investors than senior debt, floating rate notes, covered notes or deposits, and so investors should be paid more to take this extra risk. And Australia's history in this market, at least as far as retail investors are concerned, dates back to the late 1990s when NAB issued a security known as income securities or national income securities, where a hybrid or two components stapled together, a fully paid debt security of $100 or a note and an unpaid preference share, and those two were stapled together and couldn't be traded separately. The last of these were redeemed in 2021. This market really boomed in the early part of the century with CBA issuing the first of its so-called pearls in 2001. Now, Pearl is a cute acronym for Preferred Exchangeable Resettable Listed Shares. In effect, a former preference share paying a floating rate quarterly payment, in the case of the first issue of 1.85% above the bank bill swap rate, and fully franked, meaning investors received 5.6% in the first year. And retirees lapped these up. And in turn, the CBA enjoyed relatively low-cost funding. These first ones were redeemed in 2006, but the CBA has come back to the well regularly and is now up to version 15. But each one had subtly different terms, and that's the key to hybrid investing, understanding the nuances between each one. The latest Pearls 16, for example, was issued in June 2023 and raised $750 million, and that's a perpetual, subordinated, unsecured convertible note. And again, distributions were based on the floating rate note, so you're not taking interest rate risk like you would do with a long-term government bond, plus a determined margin, were paid quarterly and fully franked. CBA has the first right to call it, that is redeem it, in June of 2030 and will be forced to redeem it by June 2033. So each version is different and requires a detailed knowledge, not just of the credit of the issuer. I think we can be fairly confident that the CBA is one of the world's most secure banks and is unlikely to default on its obligations, but also the structure and how it fits in with the global rules on bank capital. Our regulators, both ASIC and APRA, were never fully comfortable with this sector, particularly when it came to retail investors. In fact, former ASIC chairman Greg Metcalfe, as a former investment banker, is probably well qualified to understand the risks, went so far as to say these are a ridiculous product for retail investors. And there's certainly no doubt that these are complex and difficult for anyone to understand. And in the early days, they were marketed as a substitute for term deposits, which clearly they're very different. Even the ASX, who obviously benefits from the listing fees, published a fairly controversial booklet back in early part of the century, 2006, I think, or 2016, titled Understanding Hybrid Securities, and called it an attractive alternative for income and it compared them to a bank term deposits, although it did notice they did come with a slightly higher risk. But this party came to an abrupt halt in 2023 when APRA announced the phase out of these hybrids, which they in the jargon refer to as additional Tier 1 securities or AT1s. And this will see the 40 billion bank hybrid market close down completely by 2032. Now, ironically, as we'll see soon, the UBS, the Swiss bank, subsequently issued an AT1 bond in Australian dollars in September of 2025, becoming the first bank to issue this type of debt in the local market since APRA's announcement. This deal was heavily oversubscribed, indicating that there's still substantial demand for this sort of product. But it does seem a little odd that the void would be filled by offshore banks and corporates who operate outside of APRA's supervision. So what happened that triggered APRA to pull the pin on this lucrative market? Well, March 2023, Credit Suisse, a 160-year-old Swiss bank, almost collapsed, having emerged from the 2008 GFC largely unscathed. Now, Credit Suisse is a systematically important bank, sort of in the too big to fail category, as it were. So the Swiss government arranged for UBS to acquire Credit Suisse for $3.25 billion US. And in the course of this rescue, the holders of Credit Suisse's hybrids lost their entire investment, while the ordinary shareholders ended up with UBS shares. And that's the opposite of what should happen, that the ordinary shareholders should have suffered losses before the hybrids. So FINMA, which is the Swiss equivalent of APRA, argued that this write-off was legally permissible because the specific terms of those Credit Suisse AT1 bonds permitted a full write-down in the event of a so-called viability event, which is one of the markers of AT1 securities, or government support, and both of these events happened. Now, this spooked the hybrid market worldwide and prompted regulators elsewhere, including APRA, to review the role of hybrids in bank capital structures and, more importantly, retail investor access to them. Now, subsequently, later court action showed that FINMA had acted unlawfully, but the writing was on the wall, the party was over. So a key part of HBRD's reason for existence will be gone by 2032. And in the meantime, the available supply of these assets will gradually dry up. So what does that mean for HBRD investors? Well, HBRD's response has been to change the investment mandate and the fund's name. So Betashares and the manager Coolabah Capital decided to change what the fund's going to invest in and abandon the hybrid index it tracked, which presumably is probably not going to be meaningful or even exist in the future. And it also decided to adopt a target of delivering 2% above the RBA cash rate over three-year rolling period. So that sort of fits with the type of investor who buys this sort of thing. Now, it fell well short of that benchmark over the last year, but probably delivered it over 5 years. It's also going to add a new type of investment into the mix, and that is securitized credit, or more specifically, investment-grade securitized credit backed by residential mortgages and other asset-backed receivables like student loans, car loans. And I would say that this increases the fund's risks and possibly more importantly creates greater duration uncertainty. So a pool of residential mortgages, which might be written for 30 years with the original borrower, has an unpredictable repayment pattern that people pay off their loans early, they move house, etc. So the duration of that bond, although the underlying loans are 30 years, is, depending on where you are in the credit stack, could be as low as 2 years, could be 5 or 6, and there's probably an incentive for the issuer to redeem where that's possible. So slightly higher risk, different return target, abandon the index. And interestingly, Betashares also took this opportunity to rejig the fee structure by combining the management fee of 0.45%, which is a reasonable management fee given the nature of the fund, and the normal fund expenses of 0.1%, and combine those into a 0.55 fee. So the Betashares, as the manager, now started to take the risk on the operating expenses. And this is a move that we'd like to see more index fund managers or more ETF managers adopt. Now, overall, we don't see these changes as particularly material for most HBRD investors. But it is a reminder for all of us, whether you're an HBRD investor or not, that no investment, even an index fund or an ETF, is a set or forget investment. And it pays to read the correspondence from the investment's issuer and to understand what that means for your investment strategy and your overall portfolio. So set and forget leads only to regret, so you need to stay on your toes. Now, while bank hybrids might not be a place for retail investors directly, this fund provides an attractive entry point because of the quality and track record of the manager, Coolabah Capital. It's not a substitute for bank deposits or fixed income in a portfolio with a growth allocation greater than 70%. But it does have a place in a portfolio for a retiree seeking income and little need for that capital currently. Personally, I'm a holder, but we don't include HBRD in any of our standard portfolios at LifeSherpa. So when we come back, we're going to look at Vanguard's new offering and what it means for Australian investors.
This is Investing is brought to you by LifeSherpa Invest. If you want your money to work harder and not just sit in a savings account earning crumbs, check out LifeSherpa Invest. Choose from 4 risk-based portfolios like Everest 90 with 90% in growth assets. Long-term, low-cost and built for people who are after serious returns. Invest from $5K today at lifesherpainvest.com.au/invest and start climbing.
Now, Vanguard, who probably needs no introduction, but is the world's second largest fund manager with $10 trillion under management. That's about 2.5 times the size of the Australian super fund assets. It's just launched an S&P 500 ETF into the Australian market. This was a notable gap in the Vanguard Australian ETF lineup, despite the fact that for Vanguard, its US equivalent, VOO, is the largest ETF in the USA with almost $870 billion in assets under management. The US-listed equivalent of IVV from BlackRock and the State Street version SPY are not far behind in terms of assets under management. So if VOO is such a big deal in the USA, why did Vanguard take so long to issue one here in Australia? Perhaps the impending 50th anniversary of the launch of it in the US could have triggered it, but there's no particular news in the press release to indicate other than consumer demand. But certainly in Australia, global equities are generally a hot sector, with international equity ETFs gaining almost $21 billion in inflows in 2025, up from $15 billion in 2024. And this includes the Vanguard MSCI Indexed International Shares ETF, a VGS, which gained $2.5 billion, and its hedged equivalent, which gained $1.4 billion. So that's almost $5 billion of inflows in 2025. There's clearly consumer demand for an S&P 500 fund. IVV has $13 billion, making it one of the largest ETFs in the country. And SPY has $400 million, so significantly smaller, but nonetheless significant. IVV has traditionally been our pick in this space. And Vanguard admits that this is a gap for them, with Duncan Burns, their Asia-Pacific Head of Investment Management, saying, "We're launching this suite of products in response to clear demand from Aussie investors for a simple, straightforward way to access the S&P 500 through Vanguard Australia." It's been the number one ask we receive, he said, when he was quoted in Money Management magazine. Now, the suite of products that he was referring to in that interview includes V500, which is the Vanguard S&P 500 ETF. Its currency hedged equivalent, V5AH, and a managed fund unhedged version called the Vanguard S&P 500 US Shares Index Fund with the APIR code VAN for Vanguard 4795AU. The ETFs are, of course, available on the ASX through any broker, and the managed fund is available through Vanguard Personal Investor or other wrap platforms or direct from Vanguard. And unlike VTS, the traditional way you would get a Vanguard exposure to the US equity market, it's a US total share market, so it's got some mid caps and some small caps as well. That's VTS. And VEU, the rest of the world equivalent, are both not available on VPI, Vanguard Personal Investor that is, but the new V500 and its hedged equivalent are. So the question that raises is, does Vanguard V500 offer anything that IVV doesn't? Well, it's not cheaper. So IVV is 4 basis points. That's 0.04%. V500 comes in at 7 basis points, 0.07%. And SPY, the third of the trio, is 0.09%. So Vanguard's in the middle of the field, but really these are vanishingly close to zero. That 0.03% is not something that should be a primary decision factor in choosing a fund. This is 5 or 6 on the list of priorities. So all vanishing close to zero. IVV is clearly the cheapest, but these are not materially different. All are operated by the world's largest asset managers. So BlackRock is number 1 with $14 trillion under management. Vanguard comes in at number 2 with $10 trillion. State Street is at number 4, and that's just behind Fidelity. So the question that does arise is, well, how are they different? And the key difference is in the underlying structure. This is what really matters. So both V500 and IVV are domiciled in Australia, whereas SPY is a wrapper for a US ETF. So iShares S&P 500 or IVV restructured from a US domiciled ETF to an Australian domiciled ETF in 2018. And in that case, the fund moved from being a CDI or a CHESS depository interest in a US trust. Now, CHESS depository interest is really a certificate that says you own a unit in the US listed ETF and a unit is held on your behalf by a company called a nominee, part of CHESS nominees. And this meant that it became Australian domiciled and there was no need for Australian investors to complete that dreaded W8BEN form every 3 years, and it reduced any potential exposure to US estate taxes. So that was very much a positive move, and in part explains its attractiveness to Australian investors. IVV invests in a US-listed ETF, so effectively the same ETF that used to be a CDI over, and that will become important when we do the direct comparison with V500. SPY SPY is still a CHESS depository interest over a US-listed ETF of the same name, and so SPY investors need to fill out the US forms. Now, V500, on the other hand, invest in the actual shares. So if you go onto the website and look at the creation basket and the holdings, you will see all 500, I think it's 503 actually, holdings. Whereas if you look at the holdings of IVV, it holds a US ETF. And that will be important, so I'll come back to that in a moment. But in the meantime, you go, unsurprisingly, IVV and SPY performed almost identically. There's 2.21% separating them over 11 and a half years, where they've both been listed, and IVV just nudges out SPY by delivering a total of 417% return over that period from October 2014 to March 2026, compared to 415% for SPY. IVV has a much higher transaction volume and a lower spread compared to SPY. That spread is 0.03% for IVV and 0.07% for SPY. SPY is much smaller. It's US domiciled. It's a CDI. It's more expensive. It's got a higher spread, lower turnover, and fractionally underperformed. So there's not a lot to particularly like there, and you certainly would not pick it over IVV. So between IVV and SPY, IVV would clearly be our preferred exposure. But does that mean that we should prefer V500 over IVV? And this is where it gets a little bit more complicated. So because V500 holds the underlying shares, whereas IVV holds a US ETF, the Vanguard option is likely to be a little bit less tax efficient because it will need to distribute some more capital gains as it rebalances within those stocks. There's no track record to compare, but I suspect it's unlikely to be materially different, but time will tell. For now, V500 is too small for us to include in a portfolio for now, but for most investors, I see no reason to sell IVV to rotate into V500. The bigger question is, would you put new money into V500 rather than into IVV? I think there's a few reasons why you might. You might if you were investing through VPI. You might if you valued the Vanguard brand. But do keep in mind that this is not one of the handful of Vanguard funds that owns Vanguard, the manager. So from a marketing perspective, any profits flow to investors in the core 12 Vanguard funds, not to owners in V500. In many ways, we see this lack of mutual ownership as a good thing because it means you're not exposed to operating risk from Vanguard. But I've covered that previously on previous episodes. I think the investment fundamentals still favour IVV, even though this difference is likely to be marginal. But I think we should watch this space, and I'll certainly come back to this in a year or so to see how the first year went. In the meantime, I'm Vince Scully, Portfolio Manager at LifeSherpa Invest, and if you'd like to discover more about how we apply these insights to deliver evidence-based portfolios with market-leading performance over the past decade, head over to lifesherpa.com.au/invest. That's it for this episode of This is Investing. So till next time, bye for now.
Thank you for listening to This is Investing. Any advice is general financial advice and does not consider your objectives, financial situation, or needs. You should consider whether the advice is appropriate for you before acting. Always read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs before buying any financial product. Vince Scully is a representative, and Simo Interactive, Pty Ltd, and Glenn James are authorised representatives of Money Sherpa Proprietary Limited, which holds Financial Services Licence 451289. And if you want further investing fun, the Quick Start Guide to Investing, as endorsed by Vince, obviously, is available wherever good books are sold, or there's a link in the show notes to get your copy today.